I think the yields of both reflect the fact that the dividends still have some questions over them. So both pay you around a 6.5% yield, which if you were sure that those yields are sustainable would look very attractive. So that's the first thing to bear in mind. I think I feel more comfortable with the Shell dividend than I do BP. Shell at its last set of results showed real improvement in cash generation and was actually just about covering the dividend with cash, whereas BP was slightly the opposite, and they've said that you need a $60 oil price for them to at least break even on free cash flow, and the oil price is still around $55, so it's not quite there yet. So I feel more comfortable with Shell, and that's why we have the larger position in Shell at the moment. So there's no favourite stock. We have around 120 positions, and we really try and be diversified in the end market exposure of those 120 holdings. So no favourite, but I think there are certainly companies that we hold that I feel don't get the attention they necessarily deserve and are particularly overlooked by the broader market. And those are often the AIM weightings, which is quite a small portion of the overall trust, around 13%. But good examples of that would be companies like Epwin, which does window and door manufacturing, Shoezone, Conviviality. These are all ones that people don't necessarily talk about very much, but are really good growing companies. If I was looking for my ISA this year, I would concentrate on the small and medium-sized company end of the UK market, which is around 2/3 of Lowland overall, so I think Lowland is quite well positioned for that. But just following Brexit, the real domestic UK economy did get derated relative to the large cap FTSE 100 index. So there is a relative valuation opportunity in those small and medium-sized company area. So if I was looking, that's where I'd focus. We don't currently own Lloyds. It's one of our biggest underweight positions relative to the broader market. If I was to talk about dividend growth at Lloyds, I would say it would be relatively muted from here, and that's because when I look at the earnings growth at Lloyds, it isn't particularly substantial, and that's because they're having to deliberately cede market share in mortgages to some of the more competitive challenger banks that have lower cost base than Lloyds. So we don't own Lloyds for that reason. I can't quite see where the earnings growth and therefore the dividend growth is coming from. We're underweight banks overall, but we do prefer banks like Standard Chartered and HSBC.